With all the volatility in the stock market and what's going on in the news about the coronavirus, a lot of uncertainty is going around with what's happening about the real estate market, and there's a lot of worry that we're going to experience the same kind of market crash that happened in 2006 and 2008. With people still having PTSD from what happened the last time, they're still afraid of buying at the wrong time. But there are many reasons, however, indicating this real estate market is nothing like 2008. And we wanted to show you 5 visuals with real-time data to show you the dramatic differences between the market right now and back when it was in 2008.
Number 1, mortgage standards are nothing as they were back then. During the housing bubble, it was difficult not to get a mortgage. Today, it is tough to qualify. The Mortgage Bankers Association releases a mortgage credit availability index. The higher the index, the easier it is to get a mortgage. As shown in the graph, the index skyrocketed back in 2008. Currently, the index shows how getting a mortgage is even more difficult than it was before the bubble.
Number 2, prices have not been soaring out of control. Here is a graph showing annual house appreciation over the past 6 years compared to the 6 years leading up to the height of the housing bubble. Though price appreciation has been quite strong recently, it is nowhere near the rise in prices that preceded the crash. There's a stark difference between these two periods of time. Normal appreciation is 3.6%. So while current appreciation is higher than the historic norm, it's certainly not accelerating beyond control as it did in the early 2000s.
Number 3, we don't have a surplus of homes on the market. We actually have a shortage. The month's supply of inventory needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued appreciation. As this graph shows, there were too many homes for sale in 2007, and that caused prices to tumble. Today, there's a shortage of inventory, which is causing an acceleration in home values.
Number 4, homes became too expensive to buy. The affordability formula has 3 components: the price of the home, the wages earned by the purchaser, and the mortgage rate available at the time. 14 years ago, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high. Wages, however, have increased, and the mortgage rate is between 3.5% to 4%. That means the average family pays less of their monthly income towards their mortgage payment than they did back then. This graph shows that difference.
Number 5, people are equity rich, not tapped out. In the run-up to the housing bubble, homeowners were using their homes as personal ATM machines. Many immediately withdrew their equity once it had built up, and they learned their lesson in the process. Prices have risen nicely over the last few years, leading to over 50% of homes in the country having greater than 50% equity. But owners have not been tapping into it like the last time. Here's a table comparing the equity withdrawal over the last 3 years compared to 2005, 2006, and 2007. Homeowners have cashed out over $500 billion less than before.
So the bottom line is, if you're worried about where the market is heading, hopefully the information we provided in this video will help alleviate your concerns.
We thank you for watching, and let us know if you have any real estate related questions that we can help you with.